Many items have been used as commodity money, such as naturally scarce precious metals, conch shells, barley, beads, etc., as well as many other things that are thought of as having value. Commodity money value comes from the commodity out of which it is made. The commodity itself constitutes the money, and the money is the commodity. Examples of commodities that have been used as mediums of exchange include gold, silver, copper, rice, wampum, salt, peppercorns, large stones, decorated belts, shells, alcohol, cigarettes, cannabis, candy, etc. These items were sometimes used in a metric of perceived value in conjunction with one another. In various commodity valuation or price system economies, the use of commodity money is similar to barter, but a commodity money provides a simple and automatic unit of account for the commodity which is being used as money. Although some gold coins such as the Krugerrand are considered legal tender, there is no record of their face value on either side of the coin. The rationale for this is that emphasis is laid on their direct link to the prevailing value of their fine gold content. American eagles are imprinted with their gold content and legal tender face value. In 1875, the British economist William Stanley Jevons described the money used at the time as representative money. Representative money is money that consists of token coins, paper money, or other physical tokens, such as certificates, that can be reliably exchanged for a fixed quantity of a commodity, such as gold or silver. The value of representative money stands in direct and fixed relation to the commodity that backs it, while not itself being composed of that commodity. Fiat money or fiat currency is money whose value is not derived from any intrinsic value or guarantee that it can be converted into a valuable commodity, such as gold. Instead, it has value only by government order. Fiat. Usually, the government declares the fiat currency, typically notes and coins from a central bank, such as the Federal Reserve System in the US, to be legal tender, making it unlawful not to accept the fiat currency as a means of repayment for all debts, public and private. Some bullion coins, such as the Australian gold nugget and American eagle, are legal tender, however. They trade based on the market price of the metal content as a commodity, rather than their legal tender face value, which is usually only a small fraction of their bullion value. Fiat money, if physically represented in the form of currency, paper or coins, can be accidentally damaged or destroyed. However, fiat money has an advantage over representative or commodity money, in that the same laws that created the money can also define rules for its replacement in case of damage or destruction. For example, the US government will replace mutilated Federal Reserve notes, US fiat money, if at least half of the physical note can be reconstructed, or if it can be otherwise proven to have been destroyed. By contrast, commodity money that has been lost or destroyed cannot be recovered. These factors led to the shift of the store of value being the metal itself. At first silver, then both silver and gold. And at one point, there was bronze as well. Now we have copper coins and other non-precious metals as coins. Metals were mined, weighed, and stamped into coins. This was to assure the individual taking the coin that he was getting a certain known weight of precious metal. Coins could be counterfeited, but they also created a new unit of account, which helped lead to banking. Archimedes' principle provided the next link. Coins could now be easily tested for their fine weight of the metal, and thus the value of a coin could be determined, even if it had been shaved, debased, or otherwise tampered with. In most major economies using coinage, copper, silver, and gold formed 3 tiers of coins. Gold coins were used for large purchases, payment of the military, and backing of state activities. Silver coins were used for mid-sized transactions and as a unit of account for taxes, dues, contracts, and fealty, while copper coins represented the coinage of common transaction. This system had been used in ancient India since the time of the Mahajanapadas. In Europe, this system worked through the medieval period because there was virtually no new gold, silver, or copper introduced through mining or conquest. Thus, the overall ratios of the 3 coinages remained roughly equivalent. In pre-modern China, the need for credit and for circulating a medium that was less of a burden than exchanging thousands of copper coins led to the introduction of paper money. This economic phenomenon was a slow and gradual process that took place from the late Tang dynasty, 618–907, into the Song dynasty, 960–1279. It began as a means for merchants to exchange heavy coinage for receipts of deposit issued as promissory notes from shops of wholesalers, notes that were valid for temporary use in a small regional territory. In the 10th century, the Song dynasty government began circulating these notes amongst the traders in their monopolized salt industry. The Song government granted several shops the sole right to issue bank banknotes, and in the early 12th century, the government finally took over these shops to produce state-issued currency. Yet the banknotes issued were still regionally valid and temporary. It was not until the mid-13th century that a standard and uniform government issue of paper money was made into an acceptable nationwide currency. The already widespread methods of woodblock printing and then P. Sheng's movable type printing by the 11th century was the impetus for the massive production of paper money in pre-modern China. At around the same time in the medieval Islamic world, a vigorous monetary economy was created during the 7th, 12th centuries on the basis of the expanding levels of circulation of a stable, high-value currency, the dinar. Innovations introduced by economists, traders, and merchants of the Muslim world include the earliest uses of credit, checks, savings accounts, transactional accounts, loaning, trusts, exchange rates, the transfer of credit and debt, and banking institutions for loans and deposits. In Europe, paper money was first introduced in Sweden in 1661. Sweden was rich in copper thus because of copper's low value. Extraordinarily big coins, often weighing several kilograms, had to be made. The advantages of paper currency were numerous. It reduced transport of gold and silver and thus lowered the risks. It made loaning gold or silver at interest easier since the specie, gold or silver, never left the possession of the lender until someone else redeemed the note, and it allowed for a division of currency into credit and specie-backed forms. It enabled the sale of stock in joint stock companies and the redemption of those shares in the paper. One of the last countries to break away from the gold standard was the United States in 1971. No country anywhere in the world today has an enforceable gold standard or silver standard currency system. Commercial bank money or demand deposits are claims against financial institutions that can be used for the purchase of goods and services. A demand deposit account is an account from which funds can be withdrawn at any time by check or cash withdrawal without giving the bank or financial institution any prior notice. Banks have the legal obligation to return funds held in demand deposits immediately upon demand, or at call. Demand deposit withdrawals can be performed in person via checks or bank drafts using automatic teller machines, ATMs, or through online banking. Commercial bank money is created by commercial banks whose reserves, held as cash and other highly liquid assets, typically constitute only a fraction of their deposits, while the banks maintain an obligation to redeem all these deposits upon demand, a practice known as fractional reserve banking. Commercial bank money differs from commodity and fiat money in two ways. Firstly, it is non-physical, as its existence is only reflected in the account ledgers of banks and other financial institutions. And secondly, there is some element of risk that the claim will not be fulfilled if the financial institution becomes insolvent. The development of computer technology in the second part of the 20th century allowed money to be represented digitally. By 1990, in the United States, all money transferred between its central bank and commercial banks was in electronic form. By the 2000s, most money existed as digital currency in bank databases. In 2012, by number of transaction, 20 to 58% of transactions were electronic, dependent on country. Anonymous digital currencies were developed in the early 2000s. Early examples include eCash, BitGold, RPOW, and B-Money. Not much innovation occurred until the conception of Bitcoin in 2008, which introduced the concept of a decentralized currency that requires no trusted third party